you all for joining us this afternoon. I am so excited, like some of the other speakers, to see you in person, but I'm also particularly excited about the launch of our new brand. The definition of equilibrium is when two opposing forces or influences come together to achieve balance. I thought I'd try and start off by showing you how good my balance is, but looking at the height of the stage, I think I might embarrass myself, so I'm not going to do that. Our marketing team's done an amazing job of showing you what the brand is all about. I think the reason I'm so excited about the Equilibrium name and the brand is that it encompasses everything that we stand for in a business. Our ability to be an independent discretionary fund manager, as we have been since our start, but with the backing of one of the top 5 financial services groups in our shareholding through Momentum Metropolitan Group. And I've been particularly fortunate that in the last 5 years, I've gotten to lead an amazing team of individuals. I think you can see some of them coming up on the screen behind me. Obviously, we're an investment business, so the portfolio managers have a skill set, CFA charter holders, actuaries, and accountants. Then we have some business development managers who also, believe it or not, have a CFA charter holder background, but they also genuinely understand advice. And then our amazing operational team that puts it all together and simplifies the investment offering as well as the execution in your particular advice practices. You're probably wondering, what exactly do I mean when I say we've always been about balance as a business? Well, there are 3 main elements that we believe we need to have perfect balance in. The first is human collaboration. We believe in building deep, meaningful, reciprocal relationships with each of you as our advisor partners. And the reason that's important, when I sit here and look at the growth in our assets, I'm so incredibly proud, and to be honest, a little bit emotional, but we're only as successful as each of your practices. So thank you. I look around the room and see so many of our clients in the audience. Thank you for the faith you've placed in us. We'd like to continue building on those relationships. And those of you who already use Equilibrium will know that we start off our relationship trying to understand your practice, the challenges you are solving for, and how together we can then build solutions that help you keep your clients invested. And you saw earlier the value of keeping them invested in some of the slides that Himna shared with you. The second area where we believe we need to bring balance is inefficiencies. And by efficiencies, I'm looking at how exactly can we make your lives easier. As a financial advisor, you know better than me that if you're sitting with a client and they invested in 5 or 6 underlying funds, and you wanting to work out how they've done when you meet with them, you've got to pull the 5 or 6 different fact sheets. Then you have to work out exactly what the asset allocation is, so how much is sitting in equities or bonds or cash, local, offshore. Then you also need to calculate what the return was in each of those and how the allocation has been to each of the underlying funds, and then try and put it all together. Now, one of the efficiencies that you get through appointing a discretionary fund manager is the institutional reporting capability that we bring. We actually combine it and show it at the combined portfolio level. So when we do our report backs and give you the quarterly investment reports, and in fact the monthly fact sheets, it actually looks at the attribution. What's driving performance? Was it the asset class that did well? Was it a particular strategy? Or was it actually each of the underlying managers? You'll hear quite a lot spoken about our brilliant investment capability, and I'm going to come to that next. But I think efficiencies are a lot more than that. It's about anticipating how the portfolios are constructed and where the risks lie. It's always great to look at a portfolio and see what's happened in the past. But I think one of the things we're particularly good at is anticipating how those portfolios are going to behave versus the peer group, so that you as advisors can have meaningful conversations with your clients and explain to them what to expect. And together, we make sure that the portfolios talk to the way you give advice. And then the last one, it's something that I'm exceptionally proud of, is our investment management expertise. And yes, we're an investment team, And I'm going to spend a lot of today's presentation just talking through how we construct portfolios and why we believe we do it in a way that keeps your clients getting to their actual outcomes. The first thing that we start off with is benchmarks. It's always good to look at a peer group for some insight into investment skill. But what the peer group doesn't tell you, if you're just looking at the peer group average, is exactly the disparity of returns in that peer group. For example, some managers in there will have 0 offshore exposure. Others will be sitting at the maximum offshore exposure. And we've seen a lot of change with the new Reg 28 changes that have come through. We go a little bit deeper than that. We actually don't believe in only using a peer group. Yes, we'll report back to you showing how we've done versus the peer group. But for us, there are 2 more important things. The first is consistency. Asset managers, ourselves included, love to put up that graph that shows if you gave us money on day 1 and you stayed with us, this is where you would have been today. And although that's great, what it doesn't say is what happened for the client that came in last week. Your client that joined us 6 years ago, the client that joined us 6 months ago, are we consistently getting your clients to the benchmarks that we say we're building portfolios for? And so for us, we believe in using less arbitrary benchmarks and being deliberate about what you're asking us to solve for. For example, are you wanting us to outperform CPI? Is that the benchmark? Let's make that the outcome or the benchmark in the actual portfolio. And then we go a little bit further, and I'll share with you exactly how we do that. So if equilibrium is about balance, 2 sides of the same equation, why is the client objective so important? Apart from the obvious fact that if you are solving for something in your advice practice, income for a client, or all your clients are actually retired and they're not interested in CPI, they want to know what their return looks like versus what they can get in a fixed deposit with the bank, it's important that the portfolios talk to that. And so we follow a 3-step process. And we tailor the investments to match your particular advice process, which means you're not forced to use our outcomes or benchmarks. We can tailor-make benchmarks and construct portfolios around what you need. Our investment philosophy is outcome-based investing. What most people don't understand is that outcome-based doesn't mean CPI or outperforming an arbitrary benchmark. It actually is deliberate about what we are trying to solve for. So there are 3 main steps that we go through. The first is trying to define the time horizon. Even if you have 2 clients and they're both trying to solve for CPI plus 2, one might be trying to get there over a rolling 2-year period, and another one over a rolling 3-year period. That has an impact on how we construct the portfolio. It'll be completely different. The second thing we look at is what is the acceptable level of risk? So for conservative portfolios, for example, we're very deliberate about the drawdown that we solve for. We know our clients in a conservative portfolio cannot tolerate losing more than a certain amount over a rolling 12-month period or any year. We saw in March 2020, where portfolios had a very deep drawdown, how hard it was for clients to stay invested. And look, we weren't protected completely. We also had drawdowns in our portfolio. But what we were deliberate about is in our more conservative funds, we actually solved particular for not giving you a huge drawdown, rather than trying to get you to the outcome at all costs. So it makes it a lot easier for investors to stay invested. And as you saw from Himna, if you can keep your clients invested, you can get much better outcomes. I think her slide said 6.5 times better. And then the last one is we look at what is a reasonable expected target. All of us would love to have no equity or volatility exposure in our portfolios and still get to CPI plus 6. The reality is that that's not possible. They're mutually exclusive. But what is possible is understanding how you give advice. What is the income we are solving for? What drawdown? And what is the actual target? And how do we get there? And that dictates how we allocate the different asset classes in our portfolio. So if we've got a 3-step process of looking at advice, we also then sit together and have a 3-step portfolio construction process. And what we think we bring is we actually bring together that gap between investment and advice, rather than trying to force clients to go into something that works for us but doesn't talk to you or your clients at the end of the day. So the most important thing we do in our portfolio construction process is we start off with strategic asset allocation. I'm sure you're bored to death of hearing how important strategic asset allocation is. But the reality is, whether you are managing portfolios locally or internationally, this is the most important decision, and it increases the probability of getting to your outcome. If you're not in the right asset classes, the chances of you ever getting to the outcome, regardless of whether it's cash, CPI, income drawdowns, is almost impossible. Then, within each asset class, we spend a lot of time saying that's not good enough. We need to actually now increase the probability of consistently getting you to your outcome. And so to do that, we look at which investment strategies or styles we believe you need exposure to, and we do it for two reasons. The first is to increase the probability, but the second is also to make sure that regardless of how the market is performing over the short term, we're still able to consistently get clients to those outcomes. So in the South African equity space, for example, there are three main styles that we look at. One is value, one is growth or momentum, earnings momentum, not momentum the house, and then the third one is quality. So when we look at optimizing our portfolios, we specifically optimize for those. A couple of years ago, you'll probably remember that most portfolio managers, or most actually advice practices, had a 70-80% exposure to value as a style. And that alone managed to get you to outperform. But the market's changed. 70% in value, especially in the offshore market, would have made sure that you definitely underperformed most of your benchmarks over the last couple of years. So instead, it's about not only looking to history and taking learnings from that, but understanding the global environment, the factors that drive returns globally and locally. And you would have heard some of that in Andrew's presentation. And then the very last thing that we do is we make a decision on which funds or how to execute using different mandates. So there we look at, for example, do we use passive or active strategies, or smart beta, or a combination of them? But it's not as easy as just saying, let's split fund and give them an equal weighting. It's actually about being deliberate. I wish I had a crystal ball and I knew exactly which funds or which asset class or styles were going to perform. The reality is that I don't have a crystal ball, and neither does anyone in the audience. So the best we can do is to try and understand deeply what drives the market and what are the factors we want to avoid to make sure your clients stay invested. And so we believe that we narrow this gap between investment and advice, making it easier for your clients to stay in the portfolios. And those of you who are our clients will know that the outcomes over the last 2 years were far better than what some of the other competitor funds did. Not because they're poor managers. In fact, I'd argue that in South Africa we have world-class managers, some of the best investment skills. But if you're a value manager and value is not doing well, it's unlikely that you're going to be able to outperform, because you probably won't do well either. Not because you don't have skill, but because your tool set is limited. Everyone's spoken about why staying invested is important. What we haven't explained is how much more important it becomes in very volatile years. So Andrew gave you some insights, and actually the portfolio construction process locally and internationally is exactly the same. Starts with strategic asset allocation, then looks at the investment styles and whether we want to execute passively, actively, smart beta, the right combination so we optimize portfolios, and then also looking at the right mandates. So actually you also get the consistency, whether we're managing local portfolios for you or hard currency offshore portfolios. And incidentally, it also informs our decision on how much to take offshore. In a conservative example again, we won't automatically go to the maximum 45% or 40% in equities or growth assets. Why not? Because the rand is one of the most volatile currencies. And often, having a weight to investments offshore can determine whether you actually get to outperform your benchmark. It has nothing to do with investment skill. It's an unintended consequence. So that's something else we pride ourselves in understanding. And actually, it's a huge thank you to our partners in the room, because you are the people sitting in front of clients. It's you that gets the feedback, what works for clients and what doesn't. And we have to rely on you to tell us what is going to work and what exactly we need to solve for. We actually very seldom meet the end investor unless you specifically invite us to do so. Okay, so why is the divergence of returns so important? If you stay invested through the cycle, you probably are going to protect yourself from your own worst behavior, trying to time the market. But the reality is clients don't stay invested. Life happens. They tell you that they've got a 6-7 year time horizon, but then a geyser bursts. They suddenly have a death in the family, or they need to buy a new car that they weren't expecting to do, save for a wedding, children's education. Each of our clients has different needs. What happens in a year when the return difference is between 13 and 22%? Your clients are probably happy. Yes, they're not going to be happy if you didn't get them the 22% that they heard on the golf course their neighbor got. But it's unlikely they're going to fire you or us if they got 13%. It's positive. But in a year like last year, where the divergence of returns was minus 23 to 94%, 114% discretion in returns, how comfortable are you as an advisor or an investment manager sitting in front of clients? And we have some of our asset managers in the room, and I promise you it's a tough discussion to have with a client, even if there's nothing we can do with markets. There's a lot of increased volatility, the conflict in the Ukraine, and the fact that people are nervous in general. Investors in South Africa are constantly saying, should we be taking money offshore? And they might be chasing this huge offshore investment without fully understanding the impact. And the other thing that we look at is we don't necessarily ignore being able to invest passively or using smart beta strategies, but we understand the risks. There's an argument to be made for actually having a portion in passives or smart beta strategies, especially for the offshore portion of your South African portfolios. Because if you're not outperforming consistently after fees, I'd argue you should be firing us the same way you would fire any asset manager. And as we know, if you invest via a platform using a feeder fund structure, often fees are the reason you don't outperform. So we try and understand that, anticipate it, and then try and reduce the risks. So I think if there's one thing that I can leave with you today, it's trying to understand risk is part of our process. When we optimize portfolios, risk is not something we do. Risk management is not something we add on. It's actually part of the whole process. Himna's already alluded to the NMG survey, and I'd love to say that the reason most of you put your faith in us is just because of our incredible investment expertise. But the reality is we can't claim that on our own. We have investment partners or asset managers that we use to execute on our behalf. And it's only fair to say it's a combined effort. There are a lot of other reasons that clients come to us. And in fact, this is something that surprised me. But the latest DFM survey, NMG survey actually showed that 38% of South African advisors are talking about practice management as one of the criteria that they would appoint a DFM and one of the most important issues in their practice. So for us, practice management's quite wide. It is about removing some of the advice risk, as Jeanette mentioned, in your practice, by making sure you have a team of investment managers whose only job is to worry about managing the portfolio. That's our job. But it's also about the way we execute. So if you've got 100 underlying clients, some of you in the room, I know, have a lot more than 100, closer to 800 or 1,000 clients. You probably get to see the smaller clients once a year. So what happens if you're invested with a manager where the whole team suddenly walks out, or the performance is particularly bad at the moment? You have to sit with each of your clients and get them to sign a switch form in order to move from manager or fund A to fund B. And we know that in the last 18 months, there's been increased corporate activity in the asset management world. We've had lots of the smaller boutiques merging. So the team who might have been managing your money is now sitting somewhere else. We've also seen big investment professionals coming out of the larger houses and going into some smaller boutiques, setting up their own shop. Those of you who do use us know that we actually like to use a combination of large houses as well as boutiques, specifically in the equity space. And the reason for that is portfolio construction is much more than just split funding. Yes, you can all construct portfolios and split between 3 different asset managers. But I'd argue if they're only large managers and they follow a valuation bias, you're actually increasing your concentration risk rather than building a truly diversified portfolio. So when we look at that, we actually say, well, our Cat 2 allows us to bring the efficiencies to you. Yes, we add value on the portfolio construction, but the other thing we do is we can switch out of one fund or manager into another at the touch of a button. So again, you don't need to worry from a TCF perspective that you're not treating your clients fairly. All your clients would have the benefit of the decision we make today, rather than it takes you a year to see each client, and the client who had your best investment view 6 months ago is far better off than someone who only gets switched out in 6 months' time or in a year's time. And then the other thing that we do is we also customize our reports to make sure that they give you all the details you need. Another bit of balance is trying to find our need for deep insights and huge data when we manage portfolios, and then customize the output into reports that are more client-centric and help you to have a simple conversation with clients where not all of your clients are CEOs of multinational companies and understand investments fully, but also giving you sufficient information that you can speak with conviction in front of your clients. We've seen a lot of market events over the last 3 years, and you'll know that we will always give you information as soon as we can on your particular portfolio. So whether it was Steinhoff, it was March 2020, or now the Ukraine war, we pride ourselves in trying to give you real-time information because we know you're seeing clients each and every single day. And then the very last thing that we bring to the party is we also talk about practice management, but what no one's spoken about today is the increase in acquisition activity in South Africa. Our average advisor is 57.5 years. I'm not quite sure where the 5 comes from. But what we know is that there are a lot of advisors who are clients who tell us that they actually want to spend more time doing other things. They don't only want to carry on running their advice practices. So they're looking at succession planning, bringing younger paraplanners or other advisors into their business. We've seen an evolution of advice, and I think either Himna or Jeanette alluded to it earlier, where people are starting to go from single practices and joining networks, or even loose networks, where you might still keep your own advice practice independent, but maybe on the investment side, you have one combined investment outlook. The other thing is we know there are lots of new entrants into the market. The reality is that we want you to extract the maximum value for the effort you have put into your practice. And whether you're looking to just grow your book, sell a book, or acquire a new book, we know it's a lot easier if you have a simplified investment offering with 5, 6, or 7 underlying portfolios, rather than trying to put 2 books together with 100 different underlying funds, often in different fee classes. So that's something we also pride ourselves, and we spend a lot of time in your own practice trying to understand. We know time is precious, and saving time saves you money. So please rely on us to do that for you if you've chosen to partner with us. And the very last thing, I don't think that an investment presentation would be complete without talking about fees. So if you are looking at appointing a discretionary fund manager, whether it's ourselves or one of our competitors, I see there's some of our competitors in the room, you'll see that all of us believe deeply on paying a fee for the service you are getting. Not all Category 2 managers, or DFMs, as they're loosely defined, offer all the services. If you're specifically looking for a team that can construct portfolios, that understands strategic asset allocation, but also knows how to make tactical calls at the margin, that understands portfolio construction and has deep relationships with the asset managers. You'll know we don't trade asset managers. We tend to buy and hold. So an asset manager is in a portfolio for a very particular reason, and that's another area where we're quite flexible. We're trying to find this perfect balance between building scale in our own business by getting clients into our off-the-shelf standard offering, and yet still allowing you as advisors the flexibility to build solutions that talk to the way you give advice, and maybe partnerships that each of you has with other asset managers. And so, as long as the asset manager is on our buy list, we are flexible. We don't force you to use our off-the-shelf offering. We can actually allow you to make a different construct. But it's important to understand how important that is at portfolio level. And by doing that, you're then able to switch one fund for another. But it's not as easy as saying, well, I don't like this boutique that you use. Let's rather give all the money to another asset manager or another boutique or a large house, because you're not getting the same. You've got to look right through to the holdings. And so when we construct portfolios, fees are important, but I want to make it very clear that the fee decision never drives our investment decision. We have a fiduciary responsibility to every investor who signs a mandate with us, and we make our decisions based on investment reasons first and foremost. But we do charge a cost-plus fee, which means that we take all the underlying fees that we use in the portfolio construction process. You need to combine those and then add our fee over and above that. Remember, a discretionary fund manager is a professional investment service. It's about the investment skill they bring, but also all those other added values to your own practice. And there's a fee for that. What you need to do when you're looking at a discretionary fund manager is understanding, do they offer all the services that you're looking for? And is the fee you're paying appropriate for the service you are getting? And then you need to actually look at the total fee. Our fee plus all the underlying manager fees. And please look at the total investment charge, because that takes into account whether your asset manager trades actively, like a Fairtree as an example, they trade a lot more, whether they tend to hold through the cycle like a Fort, and also what they bring. An example, those of you who use our funds know that we use Coronation quite actively in the local and offshore fixed income space, and some of their fees may look higher, but we understand what we're getting from that house, and we understand the skill they bring to the portfolio construction process. So we would never exclude them purely on fees. And if you're asking to solve for a particular risk budget, we can also construct portfolios as long as you understand the risks. Investing, for instance, passively in South Africa means you're taking on single stock risk. We've got 3 very large stocks in the index, one particularly large one, and so if you're just buying the index without understanding what you're getting, you're actually taking on a lot of risk. And so I think that you need to understand it in the full context. When I stand in front of an audience like yourselves, I really am humbled. Thank you for the support that each of you has given us. We wouldn't get 13.5+ billion rand without your partnership, and I value it deeply. In fact, the whole team is so proud of the partnership we have with each of you. And if you're sitting in the audience and you haven't yet spoken to us, some of our portfolio managers and myself will be around afterwards. Please come and chat to us and see if there's any opportunity for us to work together. It's always easy when you're standing on a stage trying to get new business to say we believe in partnerships. But those of you who have been our partners know that the longer we work together, the richer that investment and consulting advice relationship is. We understand your practice better, you understand ours. And we truly, our investment team is an extension of your practice. We become your personal investment team. You don't only engage with us quarterly, you engage with us whenever you need to. Thank you for the faith you've put in us. I know that I'm standing between you and our guest speaker. So please join us afterwards, and maybe some of you can show us how we can balance a gin glass and a wine glass, or maybe a coffee and a water, if you like me. But thanks again, and lovely to see you all in person. Thank you.